Right, so we have done the first part of this transaction, which you will remember was the interim dividends that we paid 720,000 Rand. We credited bank, because our bank went down, and we debited dividends paid. And now we're going to look at the second part of this transaction, which was the final dividend of 40 cents that was declared on 31 December, the year end. So it's 40 cents per share that was declared by the directors to the 300 shareholders listed. So we're not going to say 300 shareholders multiplied by 40 cents. Instead, we're going to take the total shares in issue, which is the 800,000, and we're going to multiply that by the 40 cents. So if you look at the formula bar here, at the top, 800,000 times 0.4 Rand, which is 40 cents, and that gives me my 320,000 Rand of final dividends that was declared. So let's look at my two accounts that is affected here. Number one, I do have my dividends account because I have declared more dividends. Dividends on ordinary shares. All right. This time we didn't pay any money from our bank account. We've just declared the dividends and it still needs to be paid. So if we haven't yet paid it, but we've made the promise that we will pay it, that is money that we owe, and that's a liability. And this liability specifically we call shareholders for dividends. So from the previous example, you'll remember that my dividends was a negative equity account, and my shareholders for dividends, since we owe money, that is going to be a liability account. Right, so what happened to my dividends? My dividends increased. We've declared more dividends, 40 cents per share. What happened to my liability? That also increased because we owe more money to my shareholders. So finally we can apply my debt click, which says debit, expenses, assets and drawings, which includes dividends for companies, and credit, liabilities, incomes and capital, which includes equity, if there were any increases in these accounts. So my dividends increased, so that's going to be a debit, and my liability increased, so that's going to be a credit. Okay, every debit has a credit. So very similar to the previous one, except instead of crediting bank, we are now crediting the liability, which is shareholders for dividends. So let's quickly do this in firstly our journal, which is the books of primary entry. So my journal voucher here is, or document number is the journal voucher. The day that this final dividends was declared was on 31 December. The details, the account that will debit is going to be my dividends again. Dividends on ordinary shares. And the account credited will be my liability account, which is the shareholders for dividends. Dividends account, you remember, is a negative equity, so we'll color it like that. And the amount we've determined in the calculations is 320,000 Rand. There we go. Good. Now that we've done the journal, we can post to our secondary books, which is the general ledger, also known as the T accounts. So let's post this. We need to debit dividends and credit shareholders for dividends. So we debit dividends with calculation 2, which was the 320,000. This we get from our general journal. It was at the end of the year, and we are going to credit my shareholders for dividends with 320,000 Rand. So we just make this calculation 2. This was at the year end and also from the general journal. So now in the general journal, I can refer to my general ledger account codes in the folio column. My dividends is a code N20, so let's put that in there. N20. My shareholders is B12, so let's put that in there. B12. Good. Now all that's left here is to fill in the description on these two general ledger accounts, and hopefully by now you have seen that it always refers to the other account. So in the dividends account, I cannot write dividends. I need to refer to the other leg. Okay, the husband needs to refer to her wife, and the wife needs to refer to her husband. That's in the general ledger. So the dividends account was debited, the account credited is what we're going to put here, which is my shareholders for dividends. And in the shareholders for dividends, I'm going to refer myself back to the dividends account, which is there. Okay, hopefully with the colors you can also see. You can never have the same color, the same account affected, unless of course it's another liability account. Right, lastly, the effect on the balance sheet. Again, similarly to the previous transaction that decreased my retained earnings, the final dividends declared is going to have exactly the same effect. All right, so if I go to my retained income, it's further going to reduce my retained income because now there will be even less money that the company retains, or less profits that the company retains. So it's going to be minus the 720 minus the additional 320 from calculation 2, which is the, let me just open this up a little bit. All right, and that gives me the minus 1.04 million. Good. Obviously you can see here we are not done because my total assets is not equal to total equities and liabilities. So what we need to do is record the second leg of this transaction, which was the crediting of the shareholders for dividends, which causes my liabilities to increase. So I go to my liabilities. This is going to form part of the current liabilities because I'll probably pay that within the next 12 months. So we declared it on 31 December 2013. It will most probably be paid very soon within the next year. So trade and other payables, we're going to put equal to calculation 2. And we can write that. And now we can see that my total equities and liabilities is equal to minus 720,000 as well. That's just this transaction. Obviously there would be other transactions, but we're just isolating this transaction. Great.